We're going to be getting started very shortly, ladies and gentlemen, very shortly. Why is my... Okay, my camera is not showing for one reason or another. What's going on here? All right. I don't know what happened or why my camera wasn't showing. But for one reason or another, my camera decided to not show. Can you guys hear me in the chat? Test tap 1 if you can hear me. And tap 2. Well, I guess if you can't hear me, you won't tap anything, right? So, yo. It's your boy, the insurance junkie, your fiduciary fella, the all-star advisor Alonzo Hall, your social media insurance bro and registered financial consultant. And today, as you can see, the topic is the truth about commissions. Why your insurance agent actually has your best interest at heart. And the reason I'm doing this is because I keep encountering CFPs, registered investment advisors, and Primerica scum who tend to say things like, "Oh, your agent is being commission hungry, and that's why they're selling you this whole life for this IUL." And the reality is, insurance agents have the most incentive to do the right thing by you because we get what's called a chargeback. Now, I'm going to go deeper into that because me saying that right there could be the end of the entirety of the live, but you as the consumer don't even understand the way that this stuff works. So you get inundated with inaccurate information of, oh, they're only hungry for commissions. This commission hungry insurance agent, because they can get 90% commission. Number one, our commission doesn't come out of your pocket. Unlike a real estate agent where their commission comes out of your pocket. A registered investment advisor, their commission comes out of your pocket. The only other one where it doesn't come out of your pocket, your mortgage loan originator, right? That commission doesn't come out of your pocket. They don't, well, I actually don't think that's inaccurate. I think they do charge you. For example, if they charge you a point for that mortgage loan origination, that gets put into the mortgage. Right. So there's a lot of different avenues where people are pocket watching, and they're pocket watching the most important aspect for you, which is the life insurance. You see, when most people are selling life insurance and they're going against a permanent policy or structure, they're selling death insurance. Right. And I'll finally give credit to Earn Your Leisure. Earn Your Leisure they broke it down to the most absolute simplest way for anyone to understand. They said, listen, life insurance is based on risk, right? And the insurance companies are looking at it and they're like, yeah, this is why everybody's telling you to buy term insurance. Because if you're 25 and you buy a 20 or 30-year term, the likelihood, now none of us know when we're going to die. Nobody knows the day or the hour, right? But the law of large numbers, there's not that large of a quantity of people dying between 25 and 55, right? Are there millions of people dying between 25 and 55? Absolutely. But there's tens of millions, if not hundreds of millions of people dying from 56 to 65, from 65 to 95, right? And so the closer you are in the likelihood that they will have to pay out, approximately 2% of term policies pay out, meaning that a vast majority of people don't cash in their term. Good afternoon, Lux Privé. And there's reasons behind that. So I actually decided to write a Substack article because this isn't an indictment against term insurance at all. I think term insurance is something you absolutely should have if you have dependents, right? But when you're young and healthy, it makes way less sense to lock yourself into a term insurance policy than it does a permanent insurance policy. Imagine somebody told you, because you'll never hear somebody when you're 16 and you start working, they won't tell you, don't contribute to your 401k, just throw that money in the mattress at your house, right? They won't tell you that, right? They will tell you, start putting money in the 401k and build an asset. Well, that's the same thing you should do when you're younger with a life insurance policy. But this isn't about the structure or the strategy of life insurance. This is about the pay of a life insurance agent. and how it affects you, the general public. Because again, you, the general public, keep getting fed misinformation. And I think it's important that we point to that. Now, I will be opening this later for questions, concerns, and comments, an open panel topic. I have a few guests I want to invite up so that we can go from there. But I definitely want to open it to the general public who doesn't know. So the first thing I'm going to do is I'm going to pull up my Substack article. And if you aren't following my Substack, start following it. I will start publishing pieces. And again, the reason that I published this piece was because there's so much misinformation in regards to the commissions that we get paid. So the truth about commissions, why your insurance agent actually has your best interest at heart. Now, before we continue, again, you'll have so many people who are like, hey, this commission hungry insurance agent. And are there commission hungry insurance agents? Absolutely. I guarantee you there are. In fact, I would say if you say they aren't, you'd be a bit naive. But when you have people such as myself, such as people who I affiliate with, we're not concerned with the commission. Number one, for example, hold on, as you had with Dave Kinder, who was up here, who's also an RFC, I charge a consult fee. And that does a couple of things. Number one, it diminishes. A lot of people will be, oh man, I'm not paying this consult fee. I could get this information for free. Go ahead and do so. Right? But I charge a consult fee. So now you don't have to worry about me having commission breath because you will have paid at least $1,000 up front. Right? So now you paid me, like, on the low end, let's say $300. Right? So now I'm not worried about pressuring you to purchase a policy because at least I've made something. So now I have your best interest at hand because that's just the type of person I am. But, you know, there's also that aspect. Whereas when these people are commission only, if they sit here, they're doing work, they're spending time, energy, and effort. It's not like sitting down with you, collecting your information, explaining to you these policies doesn't take time, doesn't take energy, doesn't take effort, right? They have to eat food to have the brain power to answer your questions, which means they have to have money to buy food to have the brain power to answer your questions. Greetings, Just That Sharp. So let's look here. And the truth about commissions, why your insurance agent actually has your best interest at heart. This was published today by me. This was written a couple of days ago because I go through a lot of battles on LinkedIn with, like I said, CFPs, investment advisor representatives, and even the lowly primary care agent. So there's a massive misconception in the financial world that the word commission automatically equals a conflict of interest. It is a classic case of real professionals versus content creators playing for clicks. The entertainers often paint with a broad brush, claiming that anyone earning a commission is just looking to make a quick buck at your expense. What's going on, underrated? But when you actually break down how different financial and real estate professionals get paid and the massive regulatory hurdles they have to clear, a very different reality emerges. So now if we look under the hood at the compensation structures of real estate agents, fee-based financial advisors, and commission-only life insurance agents, you'll quickly see why the insurance agent has a massive built-in incentive to get it right for you, the client, the very first time. Now, ladies and gentlemen, I'd like to interact with you in the chat. And there are no wrong answers, right? There are only your answers, right? Now, they might not be germane to what it is, but why do you think insurance agents have an incentive to get your thing done right the first time, right? Do you think it's because they can get a big commission? They can get referrals? I don't know how to post a poll. How do you post a poll in here? Telephone. There is supposed to be a way to do a poll. I don't know how to do that stuff on here, so I'm not going to do that. So, put a 1 in the chat if you think their incentive is so that they can earn this massive commissions, right? Chargebacks is the enemy. Yes, that's absolutely true. So chargebacks are the enemy, right? And that is a massive a massive portion of it. That is an incentive to get it right, because the chargeback is the enemy. And it's very difficult when you're like, cool, I just made a couple $1,000, and you can't, number one, technically you can't rest on that for a while, and number two, you're concerned with it being taken back. But do you think that the incentive is, one, so that they can get a huge commission and just get the sale? Two, because regulatory authorities and they could lose their license if they don't do it right? Or three, just because it's the right thing to do? Or four, a combination of all three? I want you guys to put that in the chat. I'm going to wait a second. So Shar thinks it's a combination of all three. Okay, that's fair. And I wouldn't say you're off on that. The reality is it is a combination of all three. So if you would have said 1, 2, 3, or 4, you'd be right. So now, give me 1 second. Get off of my table, cat. You know not to be on the table. Yeah. Everybody say hi to Phoenix. Say hi, Phoenix. This is my obnoxious cat who's jumping on my table. Look at the camera, Phoenix. You guys already know Graham Cracker. This is the second one. Now, you can't be an obnoxious cat. You have to let me do my live stream, okay? He wants to work with me. Go ahead, type on the computer. Get down. All right. Where was I? So, we're going to look at the math, the mechanics, and the law. So first, let's look at the real estate agent, because nobody ever concerns themselves with the commission of the real estate agent. And I forgot to put the mortgage loan originator in this article. But when you buy or sell a house, the real estate agent is generally compensated via percentage of the final sale price. And that is either often going to come from the proceeds that the seller earns, or sometimes it may come from the buyer, depending on the way that you're buying the property, right? Versus the insurance that doesn't come out of your pocket. But let's continue. So here, the real estate agent, when they make that sale, they're generally going to charge you around 5 to 6%, which will be split between the buyers and the seller's agent. So if you buy a $1 million house, right, and you have to pay 6% commission, that means you're paying them $60,000. So if you bought a house, or if you sold a house, right, you sell the house gets sold, now you're earning $1 million. Before we even talk about capital gains tax, you have to take $60,000 out of your earnings and pay that to the real estate broker. Now, that's money coming out of your pocket. But and people do gripe about using a realtor, but generally using a realtor, you will get a higher sale price. Or also, when using a realtor, you'll get a lower buy price, right? And you'll have the ability to meet somewhere in the middle. Having been a real estate agent, I understand the struggle that a realtor goes through. because often 98% of the people who buy a house only deal with the seller's agent. So that would be me and Just Ask Shar, right? Just Ask Shar is selling the house and I'm buying it. She says she wants $1 million for the house. I tell the real estate agent, hey, listen, I'm willing to pay $1.5 million for the house, but don't tell that to Shar. Let's start at $750,000 and we'll negotiate up. Well, since the seller's agent is hired and contracted by Shar, his job is to work in her best interest. So he's not going to tell her anything about the $750,000. He's going to say, hey, Alonzo is willing to pay up $1.5 million for this house, because he's got her interest at heart. That's why you have the seller's agent. Now let's look at the buyer's agent. The buyer's agent would then go and let's say Shar is going to do a FSBO, a for sale by owner, and she has it listed at $1 million. And I have my realtor, he goes in and she says to the realtor, well, yeah, I'm charging $1 million, but I'm willing to take $600,000 for it. Well, my realtor is going to come and say, hey, listen, we're going to offer her $550,000. What? But she's asking $1 million. Don't worry about it. I am working in your best interest. The seller who's selling it by their own is interested and willing to take $600,000. So I promise you, if we come in with an offer with earnest money and some cash up front, she'll take $550,000. That's why you have the seller's and the buyer's agent. They can work at the same firm, but the seller's agent is working on her behalf. The buyer's agent is working on my behalf. I tell my buyer's agent, hey, listen, I'm willing to pay $1.5 million. The seller's agent knows she's willing to take $600,000. So we're going to meet in the middle. I'm going to tell my realtor, hey, listen, start at, a lower price. I'm willing to pay $1.5 million if necessary, but I don't want to pay that. So that realtor is going to come in and say, hey, listen, my client will pay $750,000. Now, Shar's realtor knows that she's willing to take $600,000. There aren't any more offers. $750,000, bing, but we still got to pay 5 to 6% of that. So Shar's going to get $750,000 minus 6% of that. I'm not sure what that exact number is. Let me pull up my calculator and I can tell you that. Where's my calculator? All right, so calculator. 750,000 times 0.006. So about 4,500, right? No, that's 0.006. 0.06. 750,000 times 0.06. Yeah, 45 grand. Yes, so 45,000 out of that 750,000. So now you come home with 705,000. That's before you pay capital gains tax, which if you're single, the capital gains stops anything above 250,000 would be where you would pay your capital gains tax, right? If you're married, anything above 500,000 would be where you get your exemption up to 500,000. And again, that's different from a residential property to an investment property. I'm not a real estate agent any longer, so don't take my word for it. Make sure you find a qualified real estate professional, some of whom I know. I'm not going to particularly promote right now because they're not working with me. I'm not working with them, right? But I know some, and I'm willing to go ahead and give that information out. But at the end of the day, that commission comes out of your pocket. Right? Now, when does the agent get paid? Well, the realtor gets paid at the closing table. So once the ink is dry and the keys are handed over, the funds are dispersed, the transaction is complete. So if you wake up 6 months later and you realize that you bought too much house or end up house poor like a lot of people, or the property taxes are suffocating your budget, the real estate agent doesn't have to return their commission. The mortgage loan originator doesn't have to return their commission. They've earned their commission. So they've earned that $45,000. Plus, likely another 7,500 because the mortgage loan originator is going to put a point on their mortgage, or 1% for originating the mortgage. Right? Their job was to facilitate the transaction, and once it closes, their financial risk is over. So they're not concerned with if you buy too much house. That's why you'll hear, shout out to my guy JT the Pocket Watcher, who is a CFP and a CPA, was explaining, hey, I find it ridiculous that people fall for this. If you're paying $2,000 a month in rent, you might as well pay $2,000 a month in mortgage and have that go towards owning something. Whole different capacity of what you're spending money on, right? Because, for example, if you spend, $25,000 to rent a Bugatti, or you spend $25,000 to buy a used Lexus, right? There's going to be different things. See, that $25,000 you spent to rent the Bugatti, everything's covered. If that Bugatti crashes, I don't worry about it. The rental company worries about it. Yeah, I'm out 25 grand, but I ain't got to worry about maintenance, nothing. Tire blew, I don't have to worry about that. But now you own this Lexus, tire blow, I got to worry about it. Radiator blow, I got to worry about it. The AC don't work, I got to worry about it. A window crank messed up, I got to worry about it. A chip in the windshield, I got to worry about it. The insurance, I got to worry about it. Gas, well, you got to worry about that either way, but I got to worry about it, right? Windshield wiper fluid, anything, I got to worry about. Storing it, if it gets stolen, I got to worry about it. So the costs may add up. Now, again, spending $25,000 on renting a Bugatti is a little ridiculous, but hey, some people might do it. But again, that $45,000 comes out of you, the consumer's pocket. So now let's look at the fee-based advisor, right? So this is the one that charges an ongoing AUM model. Now, generally, there are two differences. There is a flat fee or a fixed fee advisor, which may charge, let's say, $15,000 a year. And there is an AUM, or a percentage of AUM, which is the most common financial advisor you can think of, right? And they're not exactly much more of a financial advisor than an insurance agent. There's this argument going back and forth that if you only have your insurance license, you can't call yourself a financial advisor. That is an absolute lie. You can't call yourself an investment advisor. So your life insurance agent is a financial advisor, because they go through a lot of the same things that your investment advisor does, except for putting you into a mutual fund, or putting you into a RILA, or putting you into an ETF, right? And those are registered investment advisors, right? But they're not investment licensed. They're securities licensed. That's the Series 6 and the 63. Because they can't sell you an investment. They can sell you an investment product, but an investment would be them setting up your brokerage account and then them also selling you things like an IPO. I had an idiot say that with the Series 6, you can offer an initial public offering. You can't. Just like these people who tell you about day trading, they can't. So a fee-based financial advisor typically charges you a percentage of your assets under management, usually around 1% annually. So if you have $500,000 invested, they earn roughly $5,000 a year to manage it, often billed quarterly. The problem is that when they're managing these assets, especially if they're Series 6 license, they're not managing it. They're putting you into a prepackaged fund. Those are passively managed assets, not actively managed. And this is a problem with the general public. Just like with car insurance, 15 minutes will save you 15% or more. Well, if you spend a little more than 15 minutes, you might learn something, right? I have a bunch of people. I have a buddy out here who had an insurance policy with State Farm. He had a fire. They gave him $20,000. He was like, yo, my belongings were worth way more. Unfortunately, you didn't spend the time with the agent. The agent probably put you in the type of policy that had your belongings listed as economy. So they're not going to replace these gold pillars and marble floors with heating mechanics underneath, because you didn't pay for that protection. You paid for plywood and 2x4s. So they're going to replace plywood and 2x4s. But again, so a fee-based financial advisor typically charges a percentage of your assets under management, usually around 1% annually. If you have $500,000 invested, they earn roughly $5,000 a year to manage it. And again, that $5,000 is coming from that $500,000 you invested. So you invested $500,000, but now you're going to earn your percentage on $495,000, right? So this model is generally celebrated because it aligns the advisor's success with your success. If the portfolio grows, their fee grows. If it shrinks, their fee shrinks. That's partially terms and conditions matter. Absolutely. So that's partially true, that if your assets grow, their fee grows, and if your assets shrink, their fee shrink. So here's what happens. Generally, it's tiered. So they'll charge you X percent on the first million, Y percent on the next million, Z percent on the next million. So it'll say, well, you have a total of a 0.9% bips or basis points, or 0.9% or 90% of 1%, right? 9/10 of a 1%. And so you're thinking, well, if I have $1 million, I'm only going to get charged $90,000 instead of $100,000. But again, that $100,000 is coming out of the $1 million you went to invest, right? Or that $90,000. But if your account accretes or grows, and they're still charging that 1%. So let's say they're charging 1% on 1 million, right? So that's $10,000. Now your portfolio grows to 2 million. Well, you've automatically given them a raise to $20,000. But what did they do that raised your money from 1 million to 2 million? That had nothing to do with them. And if it's a passively managed account, then it wasn't like they picked any particular stocks for you to accrete. You just gave them a $20,000 raise. Now, let's say your money decreases from 1 million to 500,000. So yes, their fees decrease, and the fact that the dollar amount, nominal dollar amount, goes down, but the percentage didn't go down. So now they're going to charge you 5,000 of 500,000. Okay. So it says that this model is generally celebrated because it aligns with the advisor's success, with your success. If your portfolio grows, their fee grows, and if it shrinks, their fee shrinks. However, because the fee is on an ongoing slow drip, there is very little upfront financial risk for the advisor. If you should decide to move your money to another firm after 6 months, the advisor simply stops billing you, but they don't owe you a refund for the time that they managed your money, right? So your money sits there, and they don't care. They're generally going to try to keep your money in their custody, right? So they'll do something like rebalance the portfolio, or we need a tax loss harvest. So now you're earning money, but now you have to intentionally take a loss to avoid paying taxes. I don't want to take a loss. I got into this to accrete, not to decrease. Now, yes, are there going to be losses? Absolutely. But you want that to be incidental. You don't want that to be intentional. So now let's look at the 13-month accountability window. Okay. The life insurance agent. So here's where we get a bunch of investment advisors. Your real estate agents aren't really going to talk about it. You'll have some realtors or fix and flippers or real estate investors who say cash value life insurance is a terrible thing. And I'm like, well, I would never do real estate investment with you, because what you're saying is basically saying that the equity in my house is a terrible thing, but you're telling me to do the BRRRR method, buy, refinance, rent, repeat, or whatever the BRRR strategy. I can't think of the acronyms right now. But or buy, rent, remodel, rehab, rent, refinance, repeat, right? But that means that there's equity. So to tell you that cash value life insurance is a terrible investment as a real estate investor means that you don't know what the fuck you're doing. So the life insurance agent, there's a 13-month accountability window. So this is going to bring us to the life insurance agent. Yes, life insurance agents are paid a commission, often a significant percentage of the first year's premium. So this is where clients get confused because they think that the insurance agent is getting paid based on what you pay. Yes, we are getting paid based on what you pay, but we're not getting paid from what you pay. Unlike the investment advisor, when you put 500,000 in there, their 1% comes from that 500,000 or that $1 million. So if I charge you $10,000, right? I'm getting paid $10,000 out of your $1 million. So now your $1 million is $999,999, right? And as he says, they're giving misinformation, right? So now let's say you pay $10,000 a year into the life insurance contract, right? And let's say I get 90% commission, right? So I get $9,000 out of that $10,000 you paid into the policy. Now people will be like, well, that's insane. You get $9,000 and I pay $10,000. That $9,000 does not come from your pocket. That $9,000 does not come from your premium. That $9,000 comes from a marketing budget that the insurance company has. So just like you see State Farm paying big bucks to have Chris Paul and Aaron Rodgers and all these football players go, like a good neighbor, State Farm is there, right? That money isn't coming from you paying for your car insurance. That money is coming from a marketing budget. So they're paying to market so that they can have Jake from State Farm. Because Jake from State Farm doesn't sell insurance, but he's not doing those commercials for free. So the insurance company has already built a marketing budget that they're going to say, hey, if Alonzo sells a $10,000 policy and we pay him 90% or $9,000 of the $10,000 of the first year that you paid in, none of that comes from your cash value. None of that is coming from you. Right? Now, yes, some of the costs of insurance or expenses, yes, that's going to go to the marketing budget. But it's the same thing with a term policy. And it's the same thing with having your assets under management. And it's the same thing with a real estate transaction. See, if I buy real estate, like Shar said, that $45,000 comes out of that $750 you made. That $10,000 comes out of that $1 million you put up. That $9,000 out of that $10,000 that you put up doesn't come from your pocket. But yet they'll vilify the insurance agent commission. Now, because of this, critics love to argue that the agents are incentivized to sell you the biggest, most expensive policy possible and then run for the hills. Here's the industry secret that those critics leave out: the chargeback. So when an insurance agent writes a policy, the insurance carrier pays them an advance commission based on the assumption that you, the consumer, will keep the policy active. But it takes up to 13 months for the agent to actually justifiably earn that money. So what does that mean, ladies and gentlemen? That means that when I write a policy for you March 7th, 2026, I haven't earned my commission until April 7th, 2027. So anytime in between there, I can lose the $9,000 they just paid me. Let's look at it. So if a client cancels their policy, stops paying their premiums, or drastically reduces their coverage at any time during those first 13 months, the insurance carrier reaches right back into the agent's bank account and takes the commission back. This is what we call a chargeback. Now, they won't exactly reach into your pocket, but what they will do is, let's say I make that sale and it's $9,000 commission, and then it charges back. And then I make another sale that's a $5,000 commission. Well, I won't get paid $5,000. Well, what will happen is I will just owe the insurance company $4,000. Right? And then what happens? I make another sale of $2,000. Well, I don't get any of that $2,000. I just now owe the insurance company $2,000. And now let's say I make another sale of $4,000. Well, I don't get that $4,000. I just get $2,000 because I still owe the insurance company an additional $2,000. And guess what? All of those commissions came from the insurance company, not you, the client. It didn't come out of your money. Now, there's laws that we're going to talk about here in a minute. But because of this window, if an agent sells you a premium you can't afford, you'll let the policy lapse and the agent gets a chargeback. Do you think we want to sit there and have chargebacks? If I've got a mortgage to pay, I need to make sure that I can pay my mortgage, right? For the house that I bought from the real estate agent that took $45,000 from you, from your pocket, right? So now I have to make sure that I can pay for this $750,000 house, right? So if I sell you the wrong policy and then you realize that it doesn't fit your plans, you're going to cancel it. And I'm going to get that charge back. So the insurance agent is structurally forced to ensure that the policy fits your budget perfectly for the long haul. Right? Because 13 months, that means a year and a month, right? Imagine any other product you sell. Because if in real estate, if I sell you the house, I wipe my hands. Done. That's all, that's it. Right? I don't have to worry about 1 minute after I'm done, you getting the agendas and changing your mind. Hey, listen, the contract signed, you can sell the house, but you can't change your mind now. You signed the paperwork. Sorry. See you later. Deuces, in the words of Chris Brown. Right? Your investment advisor might say, hey, listen, I've already charged you your AUM fee of $10,000. You want to bounce? Deuces. But they might say, hey, listen, stick it out. Don't sell. Hold on for dear life, like they say in crypto. Let your money stay there, because the longer your money stays under their custody, the more assets under management they're getting. And they're not doing anything. Tax loss harvesting, rebalancing, all of that stuff is done via an app nowadays. They click a button. There's no difference in managing a $1 million portfolio versus a $10 million portfolio. There's really no difference, especially when you're putting it into passively managed products like mutual funds, like ETFs, like, FXAIX. They're not doing anything to make that accrete or grow. But when your balance or the assets that you have from them grows from 1 million to 2 million, now instead of paying them $10,000, you pay them $20,000. You gave them a $10,000 raise for what? What did they do other than nothing to change your situation? Yet we talk about the insurance agent as if they're this criminal. So now we're going to look at the regulatory wall. Regulation BI, Regulation 187, and Regulation 60. So before I go there, there is something called suitability. And this is what a lot of CFPs and financial AUM financial advisors will say, well, yeah, the insurance agent only has to advise towards suitability. And the reason that baffled me is because I operate out of the state of New York. The state of New York has Regulation 187, which means, yes, suitability is involved, but you have to act under the best interest, in their fiduciary interest, right? And let me just drop the F-bomb. Fiduciary. The fiduciary standard really means, and this is where people don't adhere to the fiduciary standard, you need to not offer a proprietary product. So if you're with a company and all you offer is that company's things, you're not acting in a fiduciary capacity. As a fiduciary, you have to tell them how you're being paid and if what you're offering is a conflict of interest. That has satisfied your fiduciary obligation. It's not acting in the client's best interest as if they tell you, right? That's just like McDonald's saying, well, we're looking out for the health of our client by offering the mixed salad. Then you look at the caloric intake. The mixed salad has just as much harmful ingredients as the McBurger. But we're trying to make a healthier lifestyle for our clients. No, you're not. It's smoke and mirrors. So, beyond the financial mechanics of the chargeback, the regulatory environment provides a strict legal barrier against bad advice. The days of the Wild West in financial and insurance sales are long gone. Today, professionals operate under intense federal and state scrutiny. So for the securities industry, there's SEC Regulation BI, which Regulation BI also adheres to insurance. People think it only matters to annuities, but it also matters to insurance. So when a professional recommends investments, securities, or variable products like variable annuities, they are strictly governed by the SEC's Regulation Best Interest. This standard mandates that broker-dealers and their representatives must act strictly in the retail customer's best interest. They're legally prohibited from placing their own financial interests, like a higher commission, ahead of yours. Crucially, Regulation BI cannot be satisfied just by handing you a disclosure form or a Form ADV. The professional must actively evaluate reasonably available alternatives and mitigate any potential conflicts of interest before ever making any recommendation. So again, being an agent who operates out in, there are entire insurance companies who have left the state of New York because of the regulation on insurance, right? Because New York regulates insurance like they regulate securities, meaning investments. So to have a life insurance license in New York, you damn well better believe I'm a financial advisor, because I have to go through the same scrutiny. I'm going to see if I can pull up an application. Hold on. We're going to pull up an application for the state of New York and see if we can look at some of those differences there. Boom, business. Let's do New York. New business, new product line. Let's do Universal Life or products. And while I'm bringing that up, I'm going to pull up that application. And here we go. Okay. And I'm going to share this with you guys. Give me 1 second here. Let's remove this from the screen really quickly. And I just want to share with you the in-depth of how it works. Okay. So this is New York. So this, as it says, life insurance client profile form, general information, owner's name, marital status, right? Employment status, right? Their age, life insurance objectives. So we have to find out why you're even interested in buying this life insurance policy. Is it a final expense, income for survivors, paying off a mortgage, paying off debt, paying for kids' education, immediate income, chronic or terminal ill care riders, supplemental retirement income, care for permanently dependent children, pension maximization? Or is it for your legacy? Is it legacy to a family, legacy to a charity, estate liquidation, estate taxes, or estate equity? Or is it for advanced markets like a split dollar, premium finance, executive bonus, or a cross purchase buy-sell agreement? This is before I can even put in the application. I have to have this on you. So while we're filling out the application, I still have to fill this stuff out. This is stuff that your financial advisor, your guy at Charles Schwab is supposed to be getting. Your guy at Morgan Stanley is supposed to be getting. This is stuff that your guy, your local CFP isn't getting. He should be, but often he's not. I know your Primerica agent isn't getting this stuff. Let's look at the length of longest insurance need. Do you have an immediate need, meaning you're going to need this insurance within 1 to 5 years? A short term, 6 to 10 years. An intermediate, 11 to 20 years. A lifetime, 20 plus years. Is this an advanced markets case? Yes or no? If it's advanced markets, you have to already have gone to your carrier and brought this situation to your carrier and say, hey, I have an advanced market case I'm going to be working on. Now, you also have to find out their financial profile. Right? So this is not just some little piddly piss thing that you're doing. And this is just for a life insurance policy, ladies and gentlemen. So, number of financial dependents. How many people do they have that are under the age of majority that live in their household? The ages of them. What is the household annual income? What is the monthly annual income available for the premium? So I can't just be like, hey, I'm going to sell you a $5,000 a month policy and you earn, $10,000 a month, but $4,000 a month is your mortgage. And that's before any other bills, any car note. I know a guy who has a Porsche. His car payment is $1,800 a month. So imagine that's already what, $5,800 a month. Well, he doesn't have $5,000 a month available for premium. So when I submit this, and then I submit the application that says $5,000 a month for premium, the regulators are going to call me and be like, Alonzo, why did you recommend this? We're not going to allow you to issue this policy. So yes, while you wanted to get, and let's do the math, right? 5,000 times 12, right? So that's 60,000, right? So that's 60,000. Right? So my $54,000 paycheck from that $5,000 a month premium, right? I can't be premium hungry. I can't be commission hungry. I literally cannot, because I literally have paperwork. And again, this is specific to the state of New York. But I have noticed most agents who operate in New York operate in every other state as if it's New York, because New York is so heavily regulated. We just figure everybody else has our regulations. So now we're going to look at the household investable assets, the household total assets. What tax bracket are they in? What are the policy owner's monthly expenses? So we can't just put the numbers down. Now they want to go into what are your expenses? Food, medical expenses, rent, mortgage, revolving debt, property taxes, transportation, utilities, entertainment, and other recurring expenses. You can put a final number there. But then you have to justify it. Okay, how much is their mortgage? How much is their auto loan? How much is their credit card? Do they have a second mortgage? Do they have a HELOC? Do they have a student loan? Anything other? What is their monthly payment? How many years do they have left to pay this? It wouldn't work. Exactly. So life insurance agents are, in my opinion, above in standard everyone else. That's why we get diminished. If we weren't a threat to those other folks, they wouldn't diminish and do stuff so hard, right? You'll hear Primerica agents, oh man, we must be a threat. You are a threat because you go and you constantly diminish and downplay what we actually do, which is actually helpful to the client and beneficial. So now we have to combat that, right? So now we also have to find out Do they have any life insurance holdings? So holdings and assets are two totally different things. I was having a conversation with a colleague of mine who was mentioning the difference between holdings and assets, right? So it says, what are their life insurance holdings? The policy type, the cash value, the face amount, the annual premium. But then it also asks, and I have to do this for every client. So I don't care if you're just buying a Alex Trebek final expense, $15,000 face amount policy. I have to fill this out for you legally, or I face penalties, fines, and possible prison time, and the loss of my license. I need to know how many years of experience you have with mutual funds, how many years of experience you have with annuities, how many years of experience you have with equities, how many years of experience you have with life insurance. Oh, we also have to test your risk tolerance. Now, this is all stuff, ladies and gentlemen, that you're going to be going through with your financial advisor because they're securities licensed. This is the intake that you go through when you go to Charles Schwab, Edward Jones, Ariel Investments, Harlem Capital, Morgan Stanley, John and John CFP. This is the stuff that they're collecting. The lowly life insurance agent is collecting this stuff, but most life insurance agents, because they're not RFCs, registered financial consultants, cannot charge you a fee for this. I can, I will, I do, because I had to spend my 10,000 hours and my money to get to understand how to do this. There are a lot of agents who don't understand how to do these things. So now I have to find your risk tolerance. Are you conservative? Do you prefer little risk, low volatility in return for accepting potentially low returns? Minimizing the exposure of principal to loss or fluctuation is very important. Are you moderately conservative, right? You're willing to take some risk to seek enhanced returns. Are you moderate? You're willing to assume an average amount of market risk and volatility or loss of principal to achieve higher returns. Are you moderately aggressive? You're willing to assume an above average amount of risk and volatility or loss of principal to take advantage of higher potential returns. So this goes to those BS options trading courses, because they're not testing your risk tolerance, and you, the consumer, you don't even know about a risk tolerance until you lose your shirt, right? Options is highly volatile. You have to have a high risk tolerance to go into options. Why? Because 98% of the licensed people who trade options for these big hedge funds lose. Well, I'm sorry, 96%. But then of those people to actually make money and earn an income, a livable wage who trade options, 1%. So shout out to Diamond Dave, the retail trader, but I wouldn't take an options trading course. Now, he's an economist, so he may actually, I've never looked at his course, right? I don't want to diminish it, but I'm very skeptical of courses. Anybody saying, oh, yeah, I'm trading options, I'm trading the skippity pep and the pip and the dip and the candle. A broken clock is right twice a day. And it's right twice a day, every day. But overall, you're also looking at capital gains taxes, short-term capital gains taxes, which are taxed much closer to earned income taxes. Now let's continue. So, are you aggressive? Meaning you're willing to sustain substantial volatility or loss of principal to assume a high level of risk and pursuing higher returns. High risk, high reward. But we have to test your risk tolerance. Hold on. Let me see what you said here, Shar. She says, I think the courses would give an introduction. You would think so, but I've not seen it yet. I've seen a lot of people who they just show you candles. But I don't know. And that's why I don't want to diminish him. I know him personally. He's one of the only few options trading people who I would bother to listen to. Right? And that's outside of the fact that I know him on a person, because I don't like personally know him. I know him from YouTube. We've had interactions. But from number one, knowing that he has a degree in economics and he's going for credentials, one of those credentials that he's going for is the SIE, the Securities Industry Essentials. So I'm substantially more willing to trust him. Am I co-signing? Absolutely not. But I am willing to trust. So then there's funding, the sources of funding. Where are you getting the money from? Right? Is it from your current income? Is it a 1035 exchange? Is it inheritance? Is it an asset transfer? Or is there some other source where you're getting the income? Why is that? Because of money laundering. Is the policy owner willing to accept the non-guaranteed elements in the policy? So this would be specifically for an IUL, because most, or an IWL, because most whole life has strict guarantees. So now, what is the policy owner's preference regarding the flexibility of the insurance policy versus guarantees? Do you prefer flexibility over guarantee? Do you prefer guarantee over flexibility? How important is it to the insured to invest in a product that allows greater market access? Then we have to substantiate your liquidity needs. After purchasing this policy, will the policy owner have sufficient income and liquid assets to meet monthly living expenses, i.e. food, medical expenses, rent, revolving debt, taxes, transportation, and utilities in a financial emergency? Does the policy owner anticipate negative material changes to any of the following, and select an answer for each response? So, are they getting demoted or what have you? Their financial situations and needs. Are you planning to have another child, which is going to have a negative material change on your income? Existing assets. Are you going to be selling a property? Did you lose your shirt in an investment? Liquidity needs. Again, are you having a kid in the next couple months and going to have the need for more liquid capital? Liquid net worth. Are you going to have a change there? Then we have to see current holdings and assets held away. So how many assets do they have with your life insurance company, and then their total value of assets held with their investment corporation? This particular carrier is Emeritus, but most life insurance companies are also investment companies, right? So it's going to ask, let me increase this screen here because it looks a little small, right? So it's going to ask your assets held with or without them, right? And then your total of assets not held with that particular custodian, right? And then we need a breakdown of your current assets, and it has to equal 100%. What percent do you have in cash and cash equivalents, mutual funds, stocks, bonds, annuities, life insurance, alternative investments, or other? Oh, wait a second. Now I, the agent, have to explain why I recommended for you to pay $5,000 a month in a life insurance policy. Please provide a detailed explanation for the recommendation to purchase this specific life insurance policy. Attach additional pages as needed. Additional pages must be signed by all owners and the producer and currently dated. So I can put it up here and it can be signed, but if I add another page, let's say I write an insurance policy. Who do I have here in the chat? Let's say, Shar, I'm going to pick on you. I write an insurance policy on you, Shar, and then I have to write 2 pages because this 2 lines doesn't give the explanation. I have to write it. Then I have to have you sign and date that you understand that this is why I recommended this policy. What's going on, player Poppy from Playtime? Right? Yes, they're going to hate because you're telling the truth. Right? I appreciate that. Right? Unfortunately, it skews the reality, but most consumers don't see all of this stuff because most consumers don't have a situation where it really warrants us going deep into it. So what a lot of agents will say is, they'll say 0% in all this. They'll put 100% in life insurance or 50 to 50 in cash equivalents. They'll say you have no experience in certain things, right? Oh, they have no experience in annuities, mutual funds, equities, life insurance. They have 1 year of experience. So a lot of this stuff does get washed over because the general public doesn't often have an understanding of it. But again, this is why we here are wealth supremacists, right? I've told you this a while ago. Champions and contenders, but here with Alonzo Hall, the registered financial consultant, ADH Wealth Solutions, we're wealth supremacists. So we're going to dig deep, right? And now it says, please provide a detailed explanation for the recommendation to switch investment products or use funds from a checking or savings account to fund the purchase of the life insurance policy. And this is page 2 of 4. Client acknowledgement. So now the client has to say, by signing this form, they acknowledge all of the other stuff, right? They acknowledge they've been given an illustration, so on and so forth, right? So if you're like rolling over an IRA or something, right? You've been explained the range of available investment options, creditor protection, fees and expenses, tax consequences, levels of service, required minimum distributions, withdrawal loan options, and any other factors to your specific account. Then you and your co-owner would sign. Now, we also have to do the acknowledgement. Did you inform the client about the applicable features and the potential consequences of the sales transaction, both favorable and unfavorable, including but not limited to, as applicable, surrender period and surrender charge, secondary guarantee period, equity index features, availability of cash value, death benefit, mortality and expense fees, cost of insurance charges, riders, features and fees, investment advisory fees, non-guaranteed elements, policy exclusions or restrictions, insurance and investment components, market risk, potential charges for and features of riders, limitations on interest returns, guaranteed interest rates, potential tax implications associated with various transactions associated with the policy. Were you able to appropriately collect the client's suitability information? Right? Did you personally meet with all the owners and review identification documents? In your professional opinion, based on the information the client provided, do you believe the policy recommended is suitable and in the client's best interest? See, most people will say, oh yeah, they only focus on this here suitable. Why is it? They only focus on this here suitable. Why the heck? They only focus on this word, the suitability. I don't know why this PDF is bugging. But they'll say we only focus on the suitability. But if you'll notice, it says suitable and in the client's best interest as compared to other insurance or financial products that you are appropriately licensed for. So it's got to be suitable and in the client's best interest. This isn't just some little game. Then, by signing this form, I acknowledge to the best of my knowledge and belief the information is true and complete. I only considered the client's interest when making the recommendation. My recommendation was made with the skill, care, and prudence and diligence that a prudent person acting in a like capacity would do in the prevailing circumstances. I made reasonable effort to obtain the information. I reviewed the client's situation, their time horizon, and personal needs. I completed the applicable product training. I did not use the title or designation financial planner, financial advisor, or any similar title without being appropriately licensed or certified to provide securities or non-insurance financial services. I will, upon request, provide accurate and complete information of the documentation used to support the basis of my recommendation and all required documentation and disclosures provided to the client. I certify that I have completed this form accurately and to the best of my knowledge, and acknowledge that the Life Insurance Company of New York may retain this form and rely upon the representations provided above for the purpose of satisfying the obligations imposed under applicable regulations. Then I have to sign it, and I have to write my name, and I have to date it and give my contact information. Ladies and gentlemen, this is not a game. So when they say that the life insurance agent is just looking for commission, mind you, again, that commission doesn't come out of your pocket. So let's continue with the article. Let's look at New York Regulation 187, the best interest standard for insurance. And ladies and gentlemen, before I continue, if you're enjoying this content and you're finding it value, make sure you click that like, drop a comment, subscribe, hit the notification bell, and share this with somebody who needs to see it. Rael, what's going on? Let's get it, right? So as you can see, guys, there's a whole lot that goes into just selling you an insurance policy. Right? It's not just, hey, here's a policy, call it a day. And this is a reason why a lot of carriers left New York, because this requirement is not national yet. But Reg BI does not only apply to the SEC. Reg BI is now going across the country. So a life insurance agent has strict things we have to adhere to, but so many people have been diminishing the life insurance. And yes, if you'd like to join the ADH Wealth Solutions Articles group, you can do that there. Thank you, Lux Privé. And thank you, Share. So, New York is widely known for having the most rigorous financial laws in the country, and they set the tone for the industry. Under New York Regulation 187, the best interest standard was explicitly expanded to cover life insurance and annuity transactions. It removed the older, looser standard of suitability. Now, an agent cannot simply recommend a policy because it vaguely fits your profile. They must meticulously document exactly why the specific product is in your best interest, factoring in your age, liquidity needs, risk tolerance, and overall financial objectives. Everything that I just showed to you, ladies and gentlemen. Everything that I just showed to you. Right? That is Regulation BI. So I have a bunch of CFPs that I go to battle with on LinkedIn, who are like, yeah, but that's suitability. A gentleman by the name of Andy Panko. I'd love to invite him up here because I'm assuming he doesn't do business in the state of New York. A lot of people don't do business in the state of New York. Why? Because New York regulation is so strict. I can't sell a final expense without collecting that specific information, like it says here in the article. I have to meticulously document exactly why it's in your interest. Now, there's something else. They created this in the state of New York because of Primerica. The definition of replacement in Regulation 60. Let's do that. Reg 60. Let me type on Reg 60 and get that here. May we contact you? Yes. I'll close that for now. So there's a PDF. This is the producer's guide. Hold on. Reg 60. Let's go back here. Let's see. Product line. New state of New York. Any product line. We'll just do university. Boom. Add selection. No, I don't want an application kit. I want replacement forms. Right. Right. So I'm going to share this one with us as well. Bear with me here. Right. He said, but wait, there's more. There's a whole lot more. So Regulation 60, right? I want to, and I'm sharing this because there are professionals who are in this field who aren't aware of these things, because these aren't commonplace in our our world outside of New York. So I base everything on New York. So like when I see people replacing policies, right? Department of Financial Services in the state of New York, definition of replacement. In order to determine whether you're replacing or otherwise changing the status of an existing life insurance policy or annuity contract, and in order to receive the valuable information necessary to make a careful comparison if you're contemplating replacement, the agent or broker is required to ask you the following questions and explain any items that you do not understand. As a part of your purchase of a new life insurance policy or new annuity contract, has the existing coverage been or is likely to be? So if I sit down with you and let's see, best interest standard 187 reinstated by the New York Court of Appeals. This regulation requires that life insurance and annuity recommendations be made in the best interest. So when they're talking suitability, it's not best interest. We don't go by suitability. We go by best interest. Now, do we have to, when we submit, because when I submit your application to the insurance company, once the insurance company says, okay, we're willing to issue it, they send it back to me, and then I have to submit it to the suitability department. So then suitability makes sure that I did all the documentation in the best interest. And they say, you haven't done best interest, so this is not suitable. So we will not allow you to issue this policy. So now you have to go with your tail tucked between your legs and tell your client you didn't do the best possible job for them. New York Regulation Reinstatement 2022. New York Court of Appeals updated Regulation 187, defeating industry challenges and confirming that New York holds producers to a higher fiduciary-like standard of care. So this is why I stay with my New York license, right? This is why I stay operating out of New York, because I am willing to operate at the highest possible standard that there is. Not saying that people outside of New York aren't, but they aren't required to, right? Because I know a whole bunch of agents who operate outside of New York who wouldn't have a problem operating in New York because they already do this stuff. Here's one who already does that. Lux Privé. If it's legal, do it. If it's not, don't. We only do stuff that's legal, legitimate, to the letter of the law. Right? So we're going to ask you, is the current policy you have, is it going to be lapsed, surrendered, partially surrendered, forfeited, assigned to the insurer, replacing the life insurance policy or annuity contract, or otherwise terminated? So what that means is, are you going to stop paying this policy to pay my policy, the policy I'm selling you? Yes or no? 2, are you going to change or modify it into paid up insurance? So this is another reason, because I had a gentleman who did a replacement. I was like, yo, first of all, I would have done a reduced paid up, but do you guys not have Reg 60 in your state? So many places don't have Reg 60. So many places don't have Reg 180. Well, New York is the only state that has Reg 60 and Reg 187. So we're operating, and it's difficult because it also diminishes the quality of the product you can get. You can't get certain interest rates in a New York product. But are we going to change any of those cash values in any manner? Right? Those things matter. Right? Is it going to be changed or modified so as to affect a reduction in either the amount of existing insurance or annuity benefit, or the period of time existing the life insurance or annuity benefit will continue in force? So you may be doing a term conversion. You might say, listen, I have $1 million term. Well, I don't think you'll have $1 million term in Primerica because they don't do that. But I have $1 million term policy. I want to convert $500,000 to whole life and keep $500,000 in term. That's a replacement. I'm going to put the link in the chat if people want to come up and discuss, because I'm almost done with the article. Right? Are you going to reissue it with a reduction, such as that cash values are released? Are you doing a 1035? Are you going to assign it as collateral for a loan? So when people are saying that this cash value life insurance is not good, well, there's all these things that they're asking you on these applications about it. Are you going to continue with a stoppage of premium payments or reduction in the amount of premium paid? If you have answered yes to any of the above questions, a replacement defined by the New York Insurance Regulation 60 has occurred or is likely to occur, and your agent or broker is required to provide you with the important notice regarding replacement or change of life insurance policies or annuity contracts. You will also receive a completed disclosure statement no later than the time your new policy contract is delivered. Now, what does this mean with this definition of replacement? So what happens here is once you fill out that paperwork and we find that there's a replacement involved, the insurance company that you have the original contract with, the state requires me to give them 20 days to respond to me trying to replace their policy. So now they have to come up with documentation of who, what, when, where, why, how they made the recommendation to you and illustrate, right? And then I have to give my who, what, when, where, why recommendation to the state. And the state's going to take an additional 20 days after they receive what they've received, what they've received from the original agent. And then they're going to look at it and they're going to say, this is what Lux Privé has given you. And this is what Alonzo is recommending that you cancel Lux Privé's policy and take. We don't think Alonzo's recommendation is in your best interest. So no, we're not going to let him do that to you. Sorry, Alonzo, we know you wanted to make this $54,000 commission, but it's not in the client's best interest. Or, well, you know what, Alonzo, this is in the client's best interest. You can go ahead and make that $54,000 in commission because we're going to allow you to issue the policy. Now that the state has said, okay, it's okay, now I have to submit it to my agency or my carrier. My carrier has to look at it. Then it has to go through suitability, which is best interest, right? And now they're like, okay, yeah, this is in the best interest. Now it can be issued. So it takes quite a while for insurance to be issued in the state of New York. Quite a while. All right, let's get back to the article really quickly. So, critics often warn consumers about churning, the idea that an agent will tell you to cancel an old policy and buy a new one just so they can earn a fresh commission. Regulators are light years ahead of this feature. Pause. They aren't light years ahead of this feature. That's why you have this whole Kyle Busch thing going on. Mr. Davidson, how are you?
I'm doing well.
All right. I figured I'd pause, let you speak for a moment. I've been talking for an hour, blabbing and blabbing, but I think that this is important for the general public and even other advisors, because other advisors are probably not aware as to why New York is such a difficult state to work in. So I'll let you go ahead there.
So first and foremost, appreciate you having me coming up. You're always delivering exceptional value. This particular topic that you're discussing, so I went ahead and put some of the Regulation 187, how the New York Court of Appeal, which is a upper level court, how they look at it. So regardless of whatever an advisor says, we're going to go with what the law says. And if the law says taking somebody out of a product because you don't like a particular product, you're not even authorized to sell that particular product, you're only putting yourself in the crosshairs of the state regulators. It doesn't matter that you like it or don't like it. What matters is that you're looking at a potential violation of the law. And while I'm not law enforcement, they're watching you. We all hold licenses and we're held to a standard, not just to make commissions, which, as you can see, the truth about the commission. Well, the truth is, if you're a law-abiding citizen who's also a professional, you really don't have anything to worry about other than operating at your highest capacity at all times. That means operating with integrity. That means actually doing the work. That means doing your continuing education. That means truly doing what's in the best interest of your client. And so I salute you, Alonzo, for being the beacon of information when it comes to these things. There isn't anybody else doing this, as far as I know. So keep doing what you do. I'm always locked in when you're on, and yeah, I just put in the link to your Facebook group where you discuss these articles, things we talk about on a daily basis, and also Regulation 60. If you want to go ahead and dig into that, go right ahead.
Absolutely. One second. I see a question here, and thank you for the kudos. I appreciate it. So Roland Dog says, Alonzo, why does your agent want you to not get whole life? To me, it's ridiculous. It's my choice. So whole life may not always be in your best interest, right? Um, a permanent policy may not be what best fits your budget, your risk tolerance, your time horizon, or the entire amount of coverage, right? You may, for example, I tell people, when we use the term generational wealth, well, generational wealth can work a few ways, right? I can be a regular agent and say, hey, here's a policy for 10 times your annual income, right? So you make $50,000, we give you a $500,000 policy. I can be an agent who does 20 times your annual income, $1 million policy. Or I can be an agent who says, you're going to buy this $10 million face amount policy, and you're going to have a will and a trust. And in this will, your will is going to dictate that to the trust, your money is put in a money market account or a high yield savings account, because HISAs that aren't brick and mortar are churning off like 4%, right? And that high yield, that HISA or that MMA is going to be held into the trust. So the interest is going into the trust. But now most people cannot afford a $10 million whole life policy, right? So you may get a $10 million term life policy, right? It's still going to be a pretty penny, but it's going to be nowhere near how cost prohibitive it's likely to be for a $10 million policy. In fact, I'm working with somebody. I need to speak back with him. He's interested. He's in his 50s, and he's interested in a $5 million IUL. He's actually, and this goes back to the chamber and the relationships, Billy. He is the CEO of Fast Dial. Fast Dial is who Morgan & Morgan rents their phone number from. The national attorneys, they rent their phone number from him, or their phone numbers from him. And so we've been having conversations in the back. He's in his 50s, and a $5 million IUL is going to cost him about $40,000 a year on minimum funding, $40,000. Right? It's going to be way more than that. Target, it's going to cost him about $13,000 a month, right? Which is substantially more than $40,000 a year. But for a policy for just the death benefit, it would be $40,000 a year. That would make no sense for him to get a permanent policy and pay $40,000 a year. That would end up being a term policy for him. So the best bet would be to get him a term policy that $40,000 a year would be a bigger face amount. However, that policy is not for that purpose. So the Wealthy Insure One Life several times. It is your choice, but you also want to make sure that the recommendation is in your best interest. So I would recommend you get a permanent policy as well as a term policy, especially if you have dependents. If you have children, and then you have, wife, kids, mortgage, student loan debt, car note, you need a large term policy. There's no question about it. So I'm not diminishing term insurance. I sell quite a lot of term insurance. I'm product agnostic. The difficulty is when a person positions that only term insurance, or a person positions only whole life insurance, or person positions only IUL. Now, if they're positioning only IUL or only whole life because they work with people in a certain income bracket and they're working for specific strategies, right? So for example, Billy might recommend a certain product, but he's going to caveat and say, I'm specifically recommending this product for people in this category to take advantage of this strategy. I'm not saying across the board everybody should have an IUL, because that's not the truth. I hope that answers your question. And Shar says, yes, it's about educating your client.
Oh yeah, and I'll chime in on that. You have to have the education, and I'm going to go back to what you're talking about with the law. The law is the law. I don't care what advisor, what state, not even the country. You're gonna follow the law, or you're gonna get yourself in trouble. Period. And the first thing I look to is number one: is this legal? Number two: have I done the analysis to understand what you want and the capacity to execute it? If you check both of those boxes, the rest is simple. We just go ahead and do it. And when you take care of people in that matter, you don't have to go looking; they will come find you. So yeah, education 100%, and then whatever it is they want beyond that, provided that it's legal. So again, shout out to you, Alonzo, for bringing that to the forefront. The underpinnings, kind of behind the scenes of some of the stuff that we talk about on a daily basis, and it's good to give people a peek so they can see what they're getting. This isn't a commodity. This is expertise on the higher level. And I'm actually surprised you only charged $1,000, to be honest with you. You're better than me.
Everybody keeps telling me that.
You are better than me, my friend.
He said, I'm actually surprised. So, ladies and gentlemen, if the price goes up, blame Julie. No, I'm just kidding. If the price goes up, blame
No,
me.
when? It's when the price goes up.
When the price, okay, when the price goes up, yes. When the price goes up, blame me, because I've had a multitude of people, and I've realized that. So initially, Billy, I only charged $300.
Thank God you stopped doing that.
But it was like pulling teeth. But I realized that as I'm getting into certain arenas, like the gentleman yesterday, Black Diamond, he was like, "You only charging $1,000? Wow, you cheap." I had a guy charge me $1,500 just to sit down in his office, not even go over anything.
Listen, let me share something with you about that. Because you have to know your numbers.
Mhm.
And so let's say I'm talking to somebody about with a tax planning, and this is for education, informational purposes only. I am not a CPA. I am not an attorney. I don't give any advice. But guess what? You're going to get hit for 2,500 just for me to even look at whatever it is you're talking about.
Yeah.
Period. Before I tell you a single word. And people have been paying that. You want to know why? Because I'm going to tell you the things that your CPA, your attorney, even if you took a big barrel and you stuffed 75K, rolled it up to one of the most prominent attorneys in the United States and said, "Hey, I want you to give me a meeting and discuss this." They're not going to tell you the things that I'm going to tell you. You know how I know that? I've already had those conversations with those people. I know what they do. And I know what they're going to tell you. And the bottom line is, it's legal. You can do it. My most recent client, I showed him just with a couple switches of his paperwork, and the net for him is going to be $30,000 gain. Now, notice I didn't say anything about selling him a product, didn't sell him a service. I was not telling him to go get an IUL. I didn't tell him to go buy anything. Just looked at some paperwork, did an evaluation, sent him a report. He went and executed it.
Mm.
And guess what this $30,000 gain cost him, which by the way is a business expense. It only costs him $1,000. Because when you understand the value of what you do, you deliver it over and over and over. So the net is he would actually pay if he didn't do it. You see what I just did there?
Yeah, he'd actually end up paying more if he didn't pay you to get the help.
So that's why I'm looking at you like $1,000.
Again, when I'm looking in the realms of people who have it, right, in the higher net worth individuals, I realize that they'll if I start marketing specifically to HNW and ultra high net worth individuals, I won't have time to do anything, because they'll be like, listen, I'm just going to pay you $2,000 just to make you happy with the information I'm giving them. But when I'm looking at average to middle income Americans, it's seems expensive because they don't understand what you just said. I paid $1,000 to save $30,000. But if I don't pay $1,000, I think I'm saving $1,000 and I'm costing myself $30,000. So it's what is it? Penny wise, pound foolish is what ends up happening.
That's right.
Yeah. So let's continue here. Hold on, let me stack it up like this. I'm just going to put this as largest on the screen. Let me actually share this in the chat with everyone, so you can always go, subscribe to my Substack, so I can start writing more articles, because I've been told, Deontay told me I should write more articles, Billy.
Absolutely.
So I'm going to have to start doing that as well. So the churning thing, the reason I wanted to say, and you came up at the perfect time with the churning thing, let me bring us back up, was we know the Kyle Busch, which they settled that out of court.
I'm sure they did. So again, before you jump to the other subject, you're talking about a multi-billion-dollar corporation. And yes, there were some compliance issues there, but it wasn't because of the product. What actually happened was somebody slipped through the cracks, did what they did, and you have people who will take that incident and then use it to push something on you. Here's the reality. 90-something% of those policies that are put out there, and when I'm talking about IULs, they're set up fine. There are no issues, but you will have certain professionals make it look like every single agent out there, they're just selling you a horrible product and all this other stuff. So you got to look beyond the noise and see what's actually going on the back end. And so I was not aware of that. However, I'm not surprised at all.
Sorry for that. I just had to plug in my phone, but absolutely. So, let me get us back to the article so we can honor people's day, because I can do this for hours and hours. And this is the thing. When you're looking at pros like ourselves, right, and you're looking in the realms of the upper echelons, I've noticed that people don't mind doing this type of stuff all the time. And when you mention things like relationships, I didn't even realize I have a lot of the relationships that I have, because I guess where I'm at in life as opposed to where I see other people. But so Regulation 60 is the definition of replacement, and New York Regulation 60. So again, critics often warn consumers about churning, the idea that the agent will tell you to cancel an old policy and buy a new one just so they can earn a fresh commission. But regulators, especially in the state of New York, are light years ahead of this fear. Anytime a new policy is purchased and an existing one is lapsed, surrendered, converted to paid up, or heavily borrowed against, it legally triggers the definition of replacement. In New York, Regulation 60 turns this into an intentionally grueling process for the agent. So, to replace a policy, the professional must compile a massive disclosure packet comparing the old and new policies side by side. The existing insurance company is also formally notified and given a window to defend their policy to the client. So they get 20 days to respond, right? They get a whole 20 days to respond. And then in that 20 days of the ability to respond, they have to respond to me and send me their information as to what they set up. I have to send them my information as to what I set up. We both have to compare. We both have to submit it to the state. The state gets the ultimate say and saying, nah, Alonzo, you're just trying to churn this for another commission. Or, yes, Alonzo, this is going to put the client in a better situation. Or if there's virtually no difference, well, there's virtually no difference, so we'll let the client decide. Right? But they make it intentionally grueling. So you can't just go churn policies, right? So an agent simply cannot execute a replacement unless they can mathematically and logically prove that the new policy is a significant, undeniable upgrade for your financial situation. Notice it says significant, undeniable upgrade for your financial situation. They created this because of Primerica. Because Primerica was running around having people cancel their policies, and apparently now they're getting refunds. I'm like, you're not getting a refund for anybody if they've had a policy for a number of years. You're also causing them a taxable incident, because there are people who are online saying, yeah, we're getting people refunds on their life insurance. No, you're not, because now you're causing them a taxable incident. Go ahead, Billy.
Yep. Oh no. So again, I'm speaking from on the legal side, compliance, and just so you know, Lonzo, before I even came into the life insurance space, um, I was doing fraud examining, and so when I hear certain things, I begin working on my files and I do my own investigation to present them, to make my reports, to go to whatever regulatory body it needs to go to. And that is in the best interest of the general public and to not only protect our clients, but to keep bad actors out of our industry.
Yeah, absolutely. I value keeping those bad actors out of our industry because they do make our job harder, and it makes it creates the necessity for articles that I like, the one that I just wrote, right? Because the general public doesn't know. I remember I had a situation where I have an aunt who's licensed, so I recruited her to my firm. I said, listen, you're going to be on Team ADH Wealth Solutions. You're going to work under me. I'll help you close your cases. I know you don't have the experience that I have, the know-how, so on and so forth, but that's why I'm your upline, right? I'm your managing associate. So at my firm, I'm the only managing associate. Well, technically, I'm the only managing associate. We have Lindsay Smith, but she has her own agency. But so she had a client that she had a relationship with that we sat down with, and she had her mind poisoned with Primerica because they're like, the only thing they can sell you is a life insurance policy, and they're looking for this commission. Listen, chick, $50 a month. I'm not dancing over $50 a month commission. What is that, $300 a year? If I get 90% of that, that's $280.
That's such a silly thing to even say. And here's the other thing, Alonzo. Again, it's not even always about the product. It's, as you well know from early this morning, it's who do you know?
Mm-hmm.
While I might not be securities licensed, I might know somebody who actually generates greater returns than somebody who actually has that license, and I let them do their thing. But you wouldn't know that if you didn't have a relationship with me. And I wouldn't tell you that if you weren't qualified in the first place. There's levels to this game.
Absolutely. You know what? I think after the article, before I close out, I am going to show the investment status eye, but I'll mention that shortly, or statuses, I should say. So yeah, you have to, in order to replace a policy, you have to mathematically and logically prove that the new policy is a significant, undeniable upgrade for your financial situation. So I can't just go and replace your policy for no reason. Now, the bottom line is that not all compensation structures are created equal. While real estate agents clear the risk at the closing table and fee-based advisors collect as they go, life insurance agents and financial professionals are anchored to the success of your plan by a heavy chain of chargebacks and strict legal regulations. So the next time someone tells you that a commission-based insurance agent is just in it for a quick payday, remind them about the 13-month string that's attached to that check and the rigorous best interest laws that they're required to uphold. So true professionals, they don't just want to write a policy. They want to write a policy that you'll actually keep, right? And I think that's very important. Now, before I continue, hold on. Let me do like this. I'm trying to, here we go. There we go. Now, I want to add one more thing because you mentioned about the qualified or the qualifications of an investor, right? So I'm going to take us to a Google. Well, before I do that, let me just show one other piece of thing here. I'm going to share my screen again. We're going to look at, we already looked at the client profile. Here we go. So this is a producer's guide to New York Regulations 187 and Regulation 60. So just so you understand, ladies and gentlemen, once you're licensed to sell insurance and you've passed the exam, because there's a guy on LinkedIn who's like, oh, well, you know, you got to go through all these rigors to be able to sell, to be a licensed barber. You don't even have to go through that much to be able to get your license and sell IULs. That's true, but you know, it's even less rigorous to go through getting your Series 65 license and be an investment advisor and charge AUM fees, right? But what it is you're going to have to go through product training, right? So every carrier, and this is why I'm selective with the amount of carriers I have access to more than 30 carriers, but the ones that I use, I have about 5 carriers that are my main go-tos. Why? Because every carrier that you contract with, you have to go through this rigor. So now I have to read through their producer's guide, their rules and regulations, because what happens is these insurance companies will then, to adhere to the law and the regulation, they will clamp down and become more strict on their representatives and the people that they allow to offer their product. So while they'll say, hey, the state requires X, we require Y and Z. And we know that it's even more strict than X that the state requires. But we don't want the state to come in and give us any pow-pows. So therefore, we are going to be more rigorous than what the state requires on top of you, the representative representing us. So every carrier is going to have their own guide to New York Regulations 187 and 60, right? There's training requirements. Every carrier is going to have different products. So when I take their Index Universal Life training for Connecticut and the other 49 states, excuse me, other 48, it's different training than I take for New York, because then I have to go New York 187, then New York 187 IUL, then New York Reg 60, then New York Reg 60 IUL. Right? Then New York BI 187 60 IUL, whole life, annuity, whatever it is. So they have product training, then they have regulation training for the product. So if you'll notice here, New York Regulation 187 forms and documentation requirements, right? New York Regulation 187 life insurance workflow. New York Regulation 60 forms and documentation requirements. New York Regulation 60 disclosure statement completement instructions. So there's instructions for all of these. Now I'm going to go to Google. List the types of investors. From retail to, actually, you know what? No, I'm not going to do that. I'm going to go to Gemini. We're going to go to AI. List and explain the types of investors that exist from retail to institutional, and explain them in brief detail to my YouTube live stream audience. Explain the levels of income and requirements that must be met for each. Make the explanation no longer, well, I can't spell, no longer than 3 minutes. Boom. So now it's refining investor definitions. And while it's doing it, let's see, Limerica versus Regulation 60. Limerica's buy term model swaps cash value policies for term policies. In New York, this triggers Reg 60, requiring strict proof that the move's in the client's best interest. Absolutely. Which is why they likely don't do a lot of that, or they skirt around it. I mean, there are technically workarounds, right? They'll have the client cancel beforehand.
Yeah, they also do workarounds like calling in to the carrier and violating all types of telephone communication rules and regulations.
Yeah, woo-hoo. Absolutely. Absolutely true. You know, I'll even tell you one deeper. So I had a client, and he's a client that I met here on YouTube, and folks know him, Marty McFly. He bought a policy from me. He had a policy with New York Life. He was paying a certain amount of dollars a month into that policy. I saved him a certain amount of dollars a month off of that policy. He's still paying more than $1,000. And the carrier was New York Life, and this is why it's strange when they call into these customer service, because customer service is just trained to look at the screen and go from there. I'm going to leave this up with us here down here so you can see we're not changing anything, and then we're going to go read the script here, the investor ladder from retail to institutional. So he had a whole life policy with New York Life. I wrote my policy through Ameritas, and the policy issued, and New York Life, he called me pissed because he was like, yo, you guys took 2 months premium and now my mortgage payment bounced, do something. And I was like, no, we only took one premium. Our premium was only X amount of thousand, their premium was Y amount of thousand. Double check. So he double checked his bank statement. He was like, whoa, okay, it wasn't you guys, it was New York Life. What can I do about this? So I called New York Life. I said, well, initially you told them to cancel the policy effective issue. So that first premium should have been returned to you because you canceled the policy before accepting it, and we didn't trigger Regulation 187 because the policy, he had never accepted it, so it wasn't issued to him. So that's how we were able to skirt the Reg 187. I'm sorry, the Reg 60. But customer service said to him, well, we'll refund one of your premiums, right? We'll refund $2,600, right? That was his monthly premium. We'll refund $2,600, but the other $2,600 we earned because technically you were covered for a month. And I got on the phone with them and I was like, absolutely not. You guys are big. Would you like a lawsuit? I said, I'm his advisor. I told them because as his advisor, you have to get permission from the client to speak to them on their behalf. So he gave me permission. I said, listen, if that was the case and he was covered, there would be a Regulation 60. I would have had to fill out paperwork. Luckily, he was in the state of New York because outside of the state of New York, they don't have Reg 60. They still do have definition of replacement on the application, but it's not as rigorous. And so he ended up getting his full refund, which was $5,200, because they were like, oh, no, we earned it. And so what happens is customer service are usually not licensed individuals. They just know how to look at what they're looking at on the screen and read it. They don't understand the way that the products are set up by the advisor. So before I get ready to close out, I'm going to go ahead and read this to you guys in terms of the types of investors that there are, because this is also another thing when people are saying things like buy term and invest the difference. So the retail investor. At the foundation, we have the retail investor. So this is your everyday individual buying stocks, mutual funds, or ETF through a standard brokerage app or a retirement plan. Generally, I'm going to go ahead and add the caveat that generally you're not buying stocks, because when you're buying stocks through an app, you're buying, you're not buying on the open market, and you're buying fractions of a share. So for example, if you're on Cash App and you're investing on Cash App, you're not buying stocks on the open market. Or Robinhood, when everybody did the whole Robinhood thing. You're not buying stocks from Robinhood. I'm sorry, you are buying stocks from Robinhood. You're not buying stocks from the open market, because the open market, you can't buy fractions of a share. You can only buy a whole share, right? And in order to buy a whole share, you have to be an accredited investor, which as a retail investor, you're not an accredited investor, which is why as a retail investor, most of the time, your experience investing is going to be with your retirement, your 401k, an IRA, or maybe an ETF, right? Or maybe a mutual fund. But you're never going to be really experienced in corporate stock, especially not IPOs and preferred stock, right? So income and requirements, 0. There are no minimum income or net worth requirements here. If you have a few dollars and can open an account, you are a retail investor. The trade-off is that retail investors are restricted to publicly traded markets. The SEC put these boundaries in place to protect the general public from the high risks and illiquidity of unregistered private deals when you're looking at private equity. The accredited investor. The next step of the ladder is the accredited investor. Hitting this tier officially unlocks access to private markets. Think venture capital, hedge funds, angel investing, and private real estate syndications. Right? So most people aren't here. Income and requirements. To qualify, you generally must meet one of 2 thresholds. Technically, it's 1 to 3 thresholds. I'll add the third one. So income, you need to earn over $200,000 a year individually or $300,000 jointly with a spouse for the last 2 years, with a reasonable expectation to do the same this year, right? Now, here's what's funny, right? Because here, a lot of us know Kevin Samuels. Kevin Samuels used to always say a high value man would be a minimum of $10,000 a month, right? That used to be the accredited investor. So when people, well, where is he coming up with this high value? Because he took it from accredited investors. He was just like, well, I'm assuming most accredited investors are going to be high value people, right? When you have net worth of $1 million or more outside of owned real estate, residential real estate, right? So let me close that. Right? So it's strictly excluding the value of your primary residence, right? Oh, okay. It actually has the note there. You can also qualify based on pure financial knowledge rather than wealth if you hold certain active professional licenses, like the Series 765 or 82. Hold on really quickly. I'm getting a phone call. Hey, bro, I'm on YouTube Live. What's good? It's all good. All right. That was actually another financial professional who's in on this stuff with me. So then it has the qualified purchaser, right? So now you're moving into elite territory, where we have the qualified purchaser. This status grants you access to highly exclusive, large-scale private investment funds that are exempt from typical SEC registrations, right? So you're looking at income requirements. The bar here is significantly higher. It's not just about your overall net worth. It's about your investable assets. An individual or family must own at least $5 million in pure investments, stocks, bonds, investment real estate, etc. And again, it excludes your primary residence. So if you've got that $20 million home, that don't help if that's where you primarily stay. The regulatory assumption is that if you have $5 million actively working in the market, you possess the financial sophistication to evaluate complex investments without needing standard SEC disclosures to protect you. Okay? So now let's look at number 4, the institutional investor. At the very top of the food chain, we have the institutional investor. These are the whales that truly move the global market. So your income requirements, your institutional investors are large entities, not individuals. They pool massive amounts of capital to invest on behalf of others. Examples include pension funds, mutual funds, insurance companies, and university endowments. To reach the highest regulatory tier in this category known as QIB, or qualified institutional buyer, the institution must own and invest a minimum of $100 million in securities on a discretionary basis. Right? And I want to show you guys one more thing. So this is something that I did in the past, right? And did I do the... Okay, let me just see if I can... Enhanced. Okay, so no, I couldn't reload the entire chat. Here we go. So this is what I wanted to talk to you guys about the Series 6, because a lot of people hold the Series 6 and they assume that that is an investment license, and it is not. So I stated here, I often get asked about an investment license, specifically the 6. I often describe the 6 as less of an investment license and more of an enhanced insurance license. How accurate is this, and explain why? And then it came back to me. Your description of the Series 6 as an enhanced insurance license is remarkably accurate in a practical sense, though technically it is a federal securities license. In the financial industry, your framing is a common shorthand because the Series 6 is the bridge that allows insurance professionals to move from fixed products to market-linked ones. So why your description is accurate, the insurance side. The enhanced part of your description stems from the fact that most people who get a Series 6 are already life insurance licensed. Variable products. You cannot sell a variable annuity or a variable life insurance with just an insurance license. You need the Series 6 to handle the separate account. But you also can't sell them with just the Series 6. You need the life license. So the career pathing. For many agents, the Series 6 is simply the next logical step after getting their life license. It allows them to stop referring clients elsewhere when the conversation shifts from protection to growth. Limited scope. Unlike the Series 7, the general securities license, the Series 6 does not allow you to trade individual stocks or bonds. This limitation keeps the professionals focused on packaged products, which align more with the consultative, long-term nature of the insurance business, right? So it says, while my description works for 80% of the conversations, there are a few reasons why it is a little technically more than just an insurance add-on. And that's because of mutual funds and 529. So you can do those because technically there's no insurance component, right? The federal oversight. So unlike insurance licenses, which are regulated by states, the Series 6 is generally overseen by FINRA and the SEC. Fiduciary and suitability. So this is where they actually fall off, because it says it enforces representatives to a stricter regulatory framework regarding suitability, right? So the problem is that I just read to you that suitability is not just in investments; it's absolutely in insurance, right? So I said if I want to keep using this description, but add a layer of professional polish, I could say technically it is a FINRA securities license, but I call it an enhanced insurance license because it allows you to move from fixed guarantees and offer market-based products, right? So now I'm going to close that out. And I'm going to get ready to close out overall. Hold on, let me close that screen. Right? So, Billy, do you have any closing comments?
Yeah. So to all your listeners, your viewers, always do this. Verify everything. Make sure you hit the like, subscribe, share, follow. Alonzo is simply one of the best, and he's going to take real good care of you. Myself, I am, as you can see in my title, president of America's Chamber for Business, Alan, and I'm connected with other presidents and other individuals who are out there winning. and we keep it real simple. If it's legal and you've got all your documentation, we can help you win. There are opportunities abroad that you have no idea are available right now. And all it takes is sit down, have the conversation. We look at your paperwork, see if it's a good fit, get an alignment, and then just like that, pick up the phone, make a couple phone calls, and you're in business in countries you didn't even know you had the opportunity to. And so I would say the number one thing is verify everything, get it in writing, book those appointments with Alonzo. I'm telling you, if he listens to me long enough, he might even change it today. The price is gonna go up because we're gonna do evaluation on the fact that he's only charging $1,000. And once I figure out the actual number he's gonna be charged, don't be looking at me because you're the one that could have got the opportunity right now. So that being said, salute to you, Alonzo, and to all your listeners. And I wish you all the best.
Thank you so much. So, ladies and gentlemen, we've just whacked and tapped on your head with another ADH Wealth Solutions article. Make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share, share, share. With that being said, ladies and gentlemen, wipe ass, work in progress every day and see success. Wipe ass, work in progress every day and see success. Wipe ass. Work in progress every day and see success. And Billy has just challenged me to increase my price. And like I say, when people challenge you, they don't challenge you to challenge you, but they challenge you to challenge you. Accept the challenge. With that being said, ladies and gentlemen, salute. Thanks for stopping by.